With the onset of Fed tapering, that's a clear indication to us that, number one, the economy is on better footing, unemployment is going lower, as well as inflation is still very benign. But more importantly, the economic recovery that we've witnessed over the last several years has been very good and promising. In fact, as we take a look at the corporate earnings cycle right now, earnings are coming in better than expected. Corporate balance sheets are stronger than expected with cash. And so therefore, we continue to see very good opportunities going forward. Now that the Fed has finally started tapering, we don't anticipate any type of near-term knee-jerk reaction like we witnessed in May of last year. In fact, with the Fed tapering, that tells us that the economy is on better footing, that the unemployment rate is going lower, that inflation is still benign. Typically, that provides an environment where high-yield corporations, high-yield bonds, have done very well. That means that they're earning money, that they're creating more cash flow. The ability for them to service their debt and possibly get a credit upgrade is certainly higher. And so that is actually a very constructive environment for the high-yield bond market. The U.S. convertible bond market outlook is actually very promising. In fact, with all the positive credit statistics that we see from the high-yield universe, that plays a role in forming a very solid floor or base or downside protection for convertible bonds. But more importantly, as we look forward, the underlying equity progression and the underlying equity going higher will really propel the positive performance for convertible bonds. In addition to that, new issuance has come back to the convertible bond marketplace, and that's also another positive. We had the best new issuance calendar last year, the best in 6 years, and so that's a very positive sign for the CB market. Certainly, the U.S. equity market has had tremendous performance over the last several years. In fact, can we say that it's cheaper than it was a year ago, 2 years ago, or 3 years ago? Probably not. However, if we take a look at the current ratios, whether it be trailing PE, forward-looking PE, price to sales, PEG ratio, compared to the historical averages, we're still on par with, or if not slightly below, the historical averages. So from an opportunity standpoint in the equity markets, there's still some upside. There are plenty of examples in the past where the marketplace itself has traded above historical averages for not just a short period of time, but for extended periods of time. Couple that with our current environment where corporate earnings are very strong, the earnings growth has actually exceeded some recent expectations. And as we continue looking forward to 2014 and 2015, most strategists anticipate that the S&P will grow as well, or earnings will grow higher. For the upcoming year, really there's no change to the strategy at all. In fact, the philosophy and the process is what has been most consistent since the inception of the product. We're going to look for good, healthy companies earning, meeting or beating expectations quarter over quarter, year over year. In addition to that, we're going to look at the entire capital structure to identify the best total return investment, whether it be the convertible bond, the equity with a dividend and the covered call, or the high yield bond for the income and growth portfolio. So it's a total return package, each and every name that we put into the portfolio.